Hi folks, Scott here, and this is the wrap for Thursday, May 23rd. So what you're looking at here is the S&P 500 index, specifically the cash index, not a tradable instrument per se, but great for charting closing prices, moving averages, and so on. It's my primary instrument for that I track, and even using my mechanical systems when trading the ES. So the opening price is the one problem with this chart, so you have to disregard it in the candlestick patterns because the opening price is goofy. But the closing price is accurate. You'll see the red number there, 1650.51, just below the yellow number up at 1653. So we closed below, or correction, the S&P 500 closed below the 10-day moving average. First time in about a month, by the way. So I thought it'd be interesting to show you. Tomorrow is Friday. Fridays tend to be unique days. I thought it'd be interesting and helpful to show you the results of fading gaps when below the 10-day moving average, but above the 200-day moving average, and on a Friday. So I'm going to use Gap Trader, my back testing tool, and I've already set it up. Let me show you the results. There you go. So a couple of interesting nuggets that stand out here. It's happened a fair number of times over the years, 100 times over the past 10 or 11 years. Almost a 2-to-1 probability of gapping up on Fridays when below the 10-day moving average or after closing below the 10. And a gap up historically has been attractive. A gap down has been less than average in terms of historical win rates. Now this year is defying all odds because of the bullishness, so you got to keep that, I guess, in mind, even though I tend to discount recency. It's starting to get painful doing so of late. But still, a down gap looks to be riskier than average and has been a big money loser historically. Even if you got rid of this one outlier, this is based on 10 contracts, $50 a point, so divide by 500, that was a big loser. That's a 40-point loser right there. Even if you get rid of that one, you're still stuck with a sizable loss, poor profit factor, and so on, and still a weak win rate. So down gap would be more scary to me personally based upon this one data point. As always, I will defer to our gap guides and my other analysis before I make my final decision. And I'll rerun these numbers for our members in the morning using our MTG stop parameters. But even using an end of the day stop, it's definitely been riskier than normal historically. All right, let me show you. What our worksheet showed today. Worksheet's a summation or summary of all 8 individuals indices gap guides, and a gap down opening below the prior lows, 55 and 1.2. So a little bit weaker than my 60 and 1.3 criteria, but not terrible by any means. No unique day factors in play, good or bad. Unique patterns, the only risk factor we had were down gaps after a bearish outside day when above the 10 and above the 200. So that means after you closed above it and you get and have a bearish outside day, 50-50. Now it's a small sample size, so you have to discount that. The individual gap guides, I will show you those. Which way am I going? Sorry. The individual gap guides, check this out. For the ES, opening below the prior lows was pretty good, 58%, almost a 1.4 profit factor, using a stop of 5.25 points. Dow neutral though. Nasdaq right at my criteria also, not bad. Russell neutral. Looking at the ETFs, Spider looked very good. Dow slightly attractive. I'd call that neutral overall. Same with the Qs, maybe slightly attractive, and then neutral for the Russell. So it just wasn't a compelling setup on the big picture. There was nothing on the worksheet that made me want to trade it. So looking through my database and assessing other considerations. See, last night's wrap really didn't give us much insight. Either tad weak perhaps. But check this out. Large down gaps, greater than 40% of the 5-day ATR, it's my standard definition, or opening below 1648, which we clearly did, after closing above the 10 and 200-day moving averages have been terrible, 45% win rate. If opening below the 10-day moving average, numbers get worse. If opening in the DL zone, they fall apart. So another example of a small sample size being defied here, but look how lopsided this is. I will always consider a small sample size like this, if it's this lopsided, only 3 wins and 13 losses, 19% win rate probability. Today was the 4th one, so now it's 4 of 17. So pretty remarkable. The bullish market, as I've said over and over again, but that'll end someday. When? Who knows? See, fading gaps in May, sort of the standard blurb I've had here most of the month, or the second half of the month. Nothing there, just neutral. So bottom line for me, there were mostly risk factors for down gaps, especially large ones. And overall the data shows risk for fading the open and holding for gap fill. That's using historical data. So that means when the market's not playing along with historical odds, I'm going to miss winning trades. Today was a missed winning trade, even though the gap did not fill. I guess there's a small consolation in that regard. I said I plan to favor because some funds, yesterday was such a obvious and important day on the charts. It caught big money's attention, I assure you. And my thought was as long as we stayed below the prior lows, then that would favor the short side. So I'd be looking for high range fades and low breakouts. And as I acknowledged, I've been wrong on that earlier this year as well. I wasn't necessarily wrong. What happened was, let me show you the 5-minute charts. Everything pretty much rallied from the get-go, took very little heat. And the data came out was very bullish, favoring the high breakout on the 15-minute guides and the high breakout on the first hour guides. Let me show you real quickly so you don't have to take my word for it. I'm looking for 55 and 1.1. 55 and 1.1. Check. Check. Neutral in the NASDAQ. Check in the Russell. 3 of the 4 futures. Look at the ETFs. Confirmed by the spider. Again, I'm looking 55 and 1.1 of my minimum criteria on these uncorrelated strategies here. Check. Neutral in the Qs again, but check in the Russell. 6 of the 8 favored it on a large gap. So I'd have no problem going for a partial gap fill. This was only going for 40 cents in the spider or 4 points in the ES. So I had a pretty extensive physical therapy session today on my back this morning, and just the only way I could get to see my lady. And after this big bar after the open, and we pulled back, 15-minute numbers came out, I waited, saw them, set up my trades immediately because it looked like we were going to continue higher. Chaikin volume spike, had already made a big move to the upside, thought we'd likely test the lows, so I set up the high breakout. I looked at the low side of the 15-minute guides, which I won't show you for time's sake. They looked good, not quite as good, but my thought was if I got stopped, the high breakout would likely trigger first. So if I happened to get stopped out and we rolled back over, then this would greatly increase the chance of the low breakout working. Remember I showed you some of those studies, 3 of 16 finishing profitable. So there's a decent chance we're going to sell off today, and I wanted to be in it while I was gone. Plus it was a nice hedge for this trade. Great concept, one problem. I set it up. This bar wasn't even starting to really get weak. I mean, I was pretty quick on the trigger. I set the trade up and ran out the door this morning, and it sold off, triggered the next bar or two on the low breakout, which I would not have taken as the first trigger. Reverse stopped me out for 5 points, and then triggered me for the high breakout, which became a winner and made up for most of the profits, but not all. And I was also out for the first hour guides, which were also very good. I'll show you those super quickly. Did not get back in time to set those up. Missed those. Look at the high breakout here. Strong numbers, strong, check, check, neutral, check. Even better numbers of 15-minute guides in the high breakout. And the spider, check, check, neutral, and check. So 6 of 8 there. So a lot of folks reported having a very good day. So technically that I missed the gap, and I'd assume most of our probability traders did as well. We had great data to the long side, and a lot of folks did real well. I goofed it up. Like maybe I was trying too hard to trade my plan and see the doctor. Maybe sometimes you just got to take care of yourself first. But nonetheless, wasn't terrible. Just ended up net down a tiny bit. Did not do any other trades the rest of the day because we were inside of the day's range. So I wasn't looking to get short once we got inside. Just left the thing alone, and we'll see what tomorrow brings us. But there you go. That is the wrap for Thursday, May 23rd. Have a good one.